Hello and a warm welcome to yet another episode of Investor Avenue. Conversations that are brought to you by the JSE, the largest and leading stock exchange on the African continent, all to make our understanding of capital markets and our access to them as retail investors a lot simpler. Now, if you've caught up on our previous conversations, you would have learned quite a bit so far, and most importantly, finding ways of interlinking some of the previous themes and future themes that we'll discuss with today's topics. Exchange-traded funds, ETFs. It was all back in early 2001 when we saw the official first listing of the first ETF in South Africa, and boy, have we come a long way since then. One person who certainly walked this journey and has a wealth of knowledge, experience, I typically describe her as the doyen of ETFs in South Africa, is Nerina Visser, who is a director at ETF SA. Such a pleasure to have you.
Thanks for having me, Gugu. What a wonderful opportunity for us to, reflect on the past 20, 25 years of ETFs in South Africa, but also to look forward, because I think the journey has just begun.
The journey has just begun, right? And we never know who's listening, but really this is a conversation for anyone who might be a novice, intermediate, or well-experienced investor. But some might be sitting thinking, ETFs, EFT, are we talking about money in my bank account or going out or money growing? What are exchange-traded funds?
So I think it's worthwhile exploring that name, exchange-traded fund. The first two, exchange-traded, means it trades on the exchange, on the JSE.
Gotcha.
And that's probably the most important differentiating feature. Very important also is that F, the fund, because what you are investing in when you trade these things on the exchange is not a single share in a single company or a single security. You are buying a fund. And I think when we talk about some prudent investment principles, diversification is one of the first things that come to mind. And that is what you get when you invest in a fund. It's not a single investment, it's a diversified basket of shares or basket of investments that give you some of those great benefits of diversification in a single transaction that you do. So it's like a one trade, but multiple assets and benefits that you get.
Exactly. I love the description that's often shared by yourself as well as Mike Brown of ETF SA, talking about a box of chocolates, really. One might have nuts in, another has a bit of caramel, there's a peppermint option in there, but ultimately you have this option of, or wide variety of options essentially that are all fitted in to this particular basket. Let's touch on the evolution of ETFs, right?
Yes.
And I think this is really critical because it actually speaks to the plethora of options that investors have to actually make a great wealth.
Absolutely. So another sort of analogy that I also like using over and above the box of chocolates is that it's really like buying a hamper. Yes. But it's a hamper that you buy that is very transparent. It's like one that is covered in cling wrap. You can see exactly what's inside that hamper. Yeah. So if we think, sort of with Christmas coming up, you might be seeing some Christmas hampers in your store. And if it is nicely wrapped with cling wrap, you can see exactly what you're buying. But we could get Christmas hampers, or we could get Valentine's Day hampers, or back to school hampers, or all of these different types of hampers. And each of them give you something different, and ETFs are much the same. Taking my analogy of the Christmas hamper a little bit further, if I was going to equate that to a Christmas cracker, when you see the Christmas cracker, oh my goodness, beautiful, shiny on the outside, but you don't quite know what's on the inside. And sometimes you pull it open and it's like, oh, I just got a plastic whistle. That was a bit of a disappointment. So when we talk about ETFs, one of their many benefits is the transparency. The fact that you know exactly what's inside that hamper, inside that basket. It's not like the Christmas cracker where you buy something on the basis of it looking shiny and beautiful, but then getting a bit of a shock when you open it up and see, plastic whistle. So for me, it's not just the transparency, but it's also this variety of different investment types that you can get through this structure called an exchange-traded fund, an ETF.
Got you. And speaking of variety, I love the fact that you talk about hampers for different times of the year, different seasons or holidays, right?
Yep.
Because that almost speaks to the transparency of knowing what's in the hamper, but also knowing which hamper fits into which particular season.
Exactly.
Sector, geographic location. So whether we're talking offshore, local, or we're talking about mining, technology, healthcare, that also speaks to the diversity. And that's also evolved because recently also participated in witnessing the most recent listing of the Bitcoin ETF. Boy, we've come a long way now.
Oh, we've come a very long way. You know, you also didn't even mention asset classes.
Yes.
Typically, we think of the JSE as a place where you only buy shares in companies, so equities. But of course, when you're talking about an exchange-traded fund, yes, it trades on the exchange just like your shares, but what you buy is something very different. So you mentioned local or global, for example, but also asset classes. So it's a wonderful opportunity for you right here on the JSE to be able to buy into, for example, bonds, interest-bearing investments, or commodities, gold, platinum, palladium, or, as you mentioned, Bitcoin. We don't have those yet in South Africa, but I suspect we're not too far off. What we really want to focus on here is the safety and I guess the good qualities of an exchange-traded fund, and what that brings to not just the retail investor, but really whether you are a small retail investor or a large institutional investor, ETFs are equally suitable across that full spectrum of investor types.
Got you. And maybe let's focus on that safety, the security, and the cost effectiveness. Contextualize that for us, just to fully understand what that encapsulates.
So I'm going to go back to that F in the fund, because the nature of the fund that holds the assets is that these are also registered with the FSCA as collective investment schemes. Now, some of our viewers might listen to this and say, well, what on earth is that? It's just a unit trust or a mutual fund, as it's often called. I like the term collective investment scheme because it gives you some sense of the collectiveness of it. It is pooling the money of many investors together, and now you get that economies of scale when you actually buy the investments, when you buy the assets into that underlying fund. So there's one of your first cost savings. But the other beauty of it is this incredibly well-regulated environment. So the fund itself is regulated by the FSCA because it is a collective investment scheme. But then the units that you buy in the fund, so your portion of that fund is what is registered and listed on the stock exchange, the ETF units that you buy. And therefore, we now have an additional layer of regulation and security being the stock exchange.
Gotcha.
So ETFs really are probably some of the best regulated investment opportunities available to South African investors. And I think that makes them so suitable for first-time investors, people who are maybe a bit concerned about, is this safe, is this okay, or I don't have the knowledge to buy individual shares. But here's an opportunity for you in a very safe and well-regulated environment to buy a diversified basket of investments.
Exactly. I'm glad you touched on the intermediate or novice investor, but there's also a few who have some skin in the game. And perhaps it speaks to individuals like myself who have journeyed on this particular investment trajectory with yourself, where there used to be a time where ETFs were just considered passive. For the person who's just once beta, the average performance, you're not really going to shoot the lights out, or you perhaps don't want to take on too much risk. Some themes specifically around risk might be true, but help us contextualize how passive investing is actually very aggressive in itself and active, right? Especially given the new structures and formations of exchange-traded funds that exist.
Indeed. So, Gugu, you're quite right. Certainly the first, let's call it generation of ETFs, not just here in South Africa, but globally also, were of an index tracking nature. So colloquially, the term that is often used is a passive investment. I'm not particularly keen on that because it sounds like nobody's doing nothing or I don't have to think about it. The fact of the matter is, when an investment tracks an index, it gives you a lot of understanding of what is allowed to go into that particular fund, but not just what is allowed to go into it, but what will absolutely go into it. So let's take the example of the top 40 index. The very first ETF that listed on the JSE, the Satrix Top 40, tracks the top 40 index on the JSE. So some of our viewers might by now be familiar with these indices that give you a sense of what is the performance of the market. The market in this case being South African equities and the 40 largest shares. Now, I like to think of an index much the same as a recipe. I want to bake a cake. I decide, do I want to carrot cake or a chocolate cake or maybe even a cheesecake. And so I will get a recipe that tells me what are the ingredients and what are the quantities that go into my cake.
Yes.
And an index is exactly the same. The ingredients are really what are the individual companies that get selected, and the quantities are how many of each of these should I be including. But now, and so that's an index tracking fund. That's also how they track the index, by literally buying everything that's in the index. So there's no activity in order to track the index. It's just about following the recipe. But then back to my example of do I want to buy or bake a carrot cake or a chocolate cake or a cheesecake, exactly the same. An investor needs to make an active decision to select the particular index that the ETF will track.
Yes.
I use Satrix 40, and the top 40 index is an example. But there are many more indices than there are individual shares. So I can say to you, well, what about the S&P 500 index that gives you the 500 largest companies in the US? Yes. What about the MSCI World Index? Now we're talking around 1,700 companies in developed markets around the world. I can go to the All-Country World Index or the Global Index. Now we are talking 9,000 companies across the whole world.
Right? Because when we think about investing on the JSE or in an ETF listed on the JSE, we typically think, oh no, I can only invest in South African companies. But you've just listed 9,000 companies that could be options here?
With a single transaction. With one transaction, you can literally buy the entire world.
Yeah.
And so, yes, index tracking individual products, the ETFs can correctly then be called passive investments. But the decision of the investor of which ETF to invest in is a very active decision. And so I want us to move beyond this idea that investing in ETFs means I'm not doing anything. I'm passive about my investments. That is so not true.
I love it. I'm in the driver's seat. I'm taking those decisions. So certainly you can too as a viewer. And I think this is important for us also to amplify. As mentioned, we are here at the JSE, an institution that we're both very familiar with. And you've been here many a times talking about this similar topic and theme. But how it really does position investors through investing ETFs to really get global exposure. And I think so often we don't necessarily think of it that way. So perhaps as we go back to our hamper analogy, different holidays, understanding the contents, and of course, perhaps the different varieties that you can have. It's also important to understand some of the options that are available through tax-free options.
Yeah.
Help us contextualize that, and for people who might not be aware of how tax-free accounts can actually be accessible through ETFs.
Absolutely. So we often get people sort of say, I want to buy a tax-free ETF. An ETF is not tax-free per se, but the account in which you buy the ETF could be a tax-free account. So just a recap quickly of the benefits of tax-free investment accounts. 36,000 Rand contribution limit per tax year per individual in South Africa. And once whatever you buy into that, there are no taxes payable. There's no tax on interest earned. There's no tax on dividends. There's no tax on capital gains. And when we look at some of the rules that government has around these really, really great opportunities through tax-free investments, one of them is that you can't buy individual shares in a tax-free account. You can only buy these funds, the CIS, the Collective Investment Scheme funds. Gotcha. So for an investor doing a tax-free investment account on the JSE, you can only buy ETFs. And they're very, very suitable for that because you're immediately also getting that very diversified nature. But you're not restricted to just buying South African equities. You've got the whole world that you can buy here on the JSE. I want us to then also just differentiate between tax-free savings accounts and tax-free investment accounts. Yes. I think the term most people are familiar with and use a lot is just a tax-free savings account. And a tax-free savings and a tax-free investment account, exactly the same in the sense of the tax benefits that we get. But the big difference is that a tax-free savings account as its underlying only is like a savings account with a bank. The only thing that you earn in that account is interest. And yes, the interest is tax-free, but that's it. Whereas if you use that 36,000 Rand allowance that you have per year to buy investments rather than just savings, now you have the opportunity not just to save tax on interest, but tax on dividends, tax on capital gains. And so we strongly recommend to people that you use this opportunity, this allowance that government gives you, to use that for a tax-free investment account. The beauty is, if you've been participating in this opportunity with your bank, having a tax-free savings account, you can transfer everything that you currently have just in a savings account with your bank to a tax-free investment account and use all that money that you've built up already and go and buy yourself a really beautiful portfolio of ETFs in your tax-free account that gives you all of these great tax benefits.
I love it. It's like gathering the strength and the momentum through the saving. And then once you have the courage and, of course, have determined what your risk profile is, what investment strategy you're going to explore, then you go into the tax investment account, which is very critical for us to understand. Because these platforms are accessible, right? Some of us might be sitting and thinking, okay, well, where do I pick it up? Do I go to the green retailer, the red one, or the black one? But the truth is, you work for an institution as well, ETFSA, which is one of the leaders in terms of providing ETFs to South Africans as clients, and we understand that there's many other competitors and players in the industry as well.
So Gugu, I'm really glad that you asked this, because I think, coming back to the idea that we're talking about the JSE here, the only way that any investor can actually buy investments on the JSE is through a stockbroker. The broker has to be registered with the JSE, another layer of that protection that the investor has. But the traditional stockbroking model, when I or you go and we buy as an individual something, you need a relatively handsome amount of money in order to make it cost effective. Not because the JSE necessarily charges a lot of fees, but because there are certain sort of flat fees, statutory charges that are payable when you transact, which actually puts it somewhat outside the realm of the initial retail starter investor, especially somebody that wants to do it on a regular basis with a monthly debit order, for example. And that is where investment platforms come in, because investment platforms they still have to execute via a stockbroker, but you as the investor don't need to go and find that broker or deal directly with a broker. The investment platform does it for you. And the regulations allow the investment platform to pool of all the investments of all the investors on a particular day. And once again, that idea of collective, of sort of cost sharing amongst the investors, suddenly then bring that access for the retail investor down to a very affordable and manageable level. So what you want to be looking there in terms of investment platforms is a platform that can actually facilitate trading on the JSE for you. So yes, you mentioned ETFSA, the Investor Hub certainly is an option. Many people might be familiar with Easy Equities. So there are investment platforms that specifically offer investors good access to the JSE. You don't have to go out and find that broker in order to do the trading in the ETFs.
And in fact, if a broker approaches you, that's when you need to raise your eyebrow perhaps, right? Just to make sure that they're registered, are necessarily professionals within that particular realm and space. And finding the cost-effective route through the platforms that do offer a lot of success. And I think this is also a beautiful moment for us to reflect on the growth we've actually seen in the space of investors. You've been doing this for, Narina, a passion point of yours for years.
Are you going to tell them how old I am? No, can't go there, Gugu.
Young as ever, with experience. And the beauty about your experience is that you've literally witnessed many people actually come back to you and say, I started this journey 5 years ago, 10 years ago, with such an amount, with no knowledge. And this is actually how I gained confidence and have managed to see significant progress. Share some of those with us, just to understand not only that it's practical, but just the phenomenal rewards at the end when you look back and you say, hold on, those key principles, those 3 C's I taught you about, you're still putting them to practice.
Absolutely. Working with Mike Brown, the father of ETFs, who literally listed Satrix 40, the very first one, and here we are 24 years down the line, and he's still as committed and invested in this industry as it was the time. To speak to investors now who come to Mike and say, 24 years ago when you listed that Satrix 40, I did my first investment. And here they are 24 years later with beautiful stories of growth, not just in terms of their investment portfolios, but I think in terms of their confidence as investors. Those are for me beautiful stories. One of my personal favorites is a lady that just this last Saturday at the She Invests event here at the JSE, shared with me how 10 years ago she attended an event that we did back in 2015, and she knew absolutely nothing about investment. She had no investments. And she said, we gave her the courage to say, but investing in ETFs is something that is accessible to me and something that I can do. And she came and shared with me on Saturday how excited she was that she has just crossed the 1 million rand mark in terms of her investment portfolio. And she did this all herself. She did this without needing to rely on an advisor. She did this without having expert knowledge about the industry. She's learned a lot through this journey. But, you know, Gugu, it's a little bit like learning to drive a car.
Yes.
You don't learn to drive a car by reading a book about it. You actually have to get behind the steering wheel of a car and do it. And that's where ETFs are so incredibly good for first-time investors, to say not only is it cost-effective and accessible, but this is actually something that I can do with a manageable level of risk. It remains an investment, so we still recommend the longer-term profile. Give it at least 5 years. But the point is that if you're coming in with the right money, the money that is intended to plant that fruit tree for you, the seed that grows into the big tree that then has the fruit. And over time, you can eat fruit every single year. It never stops giving. You don't have to chop down the tree to get the benefit of it. If that is your approach and your attention with these investments, there's nothing better than ETFs as the investment structure or fund in which you do this.
Definitely. And I think this is so important because, as you mentioned, this is almost 10 years ago. She started with minimal knowledge and also has just kept consistent in the game. And this does speak to a strategy that I guess is a 101 for novice ETF investors. It typically has 3 C's, right? Give us a refresh on that
Absolutely. So, you know, we live in a chaotic world. We find ourselves completely overwhelmed with breaking news flow, those big red flashing screens. Indeed. I guess media also needs to sell what they do. But we are inundated with information flow that causes anxiety. And that also, I think, causes you to think that I need to do something. I need to act upon this news flow that's coming my way. And it stops many people also from investing because they say, I'm too afraid. It's too chaotic out there. I will wait until things calm down and then I will invest. And of course, we know that's never going to happen. True. So I often say the 3 C's that will calm the chaos around you is to, and these are things that you can control and that you can focus on, because I can't control the chaos in the world, but I can control on my own actions. And the 3 C's for me there is the contribution that you make, especially on a regular basis. What do I put into this? What the markets does, the market will do, but I've got to buy a ticket, an entrance ticket, and that's my contributions that I make. The second one is consistency. Because markets go up and down and all over the place, it's also, nobody's going to ring a bell and say, oh, the market is now at a low, you must buy now. No. You do this consistently every month. It becomes a healthy financial habit, much like brushing your teeth. You want to have that consistency because that is how you build wealth over the long term. And the third C, costs. Yes. There are some costs that is within your control, but I also want to emphasize for investors here. If somebody comes to you and say, oh, I've got this great investment opportunity for you and there's no costs, please run a mile, because either this is a scam, because if there's no costs, it means there's no regulatory costs. There's no protection for you as an investor, or they're lying to you and they're hiding the cost somewhere else. There is no such thing as a well-regulated, safe investment that has no costs. But there are costs that we can control. ETFs certainly represent a great way for investors to save costs. Doing it through an investment platform where you share the costs with the other investors on the day is the second one. And having the transparency, the ability for you to learn through this. You don't have to use an advisor. You absolutely can, but that advisor should be focused on helping you manage your overall financial wellness, not picking funds for you or stock picking or doing individual picks. You want somebody who's going to be your wellness, financial wellness coach on this journey with you, not sitting there trying to time the market and pick things on your behalf.
I'm so glad you emphasized this, right? Because sometimes we have these conversations about investing around the boardroom, sometimes around the braai or the water cooler at work. And depending on the setting, depending on the people you're soliciting feedback from, you'll hear a wide variety of views. Some would be opposing and others not really entrenched and steeped in good and pure financial knowledge. And this is important, as you've said, to actually make sure that you do have someone who will prepare and help you in terms of a bespoke journey to creating wealth. It also brings up a very important aspect, Nerina, which is defining what makes one a successful investor.
Oh yes. So yeah, you know, those braai conversations or those golf course conversations or wherever or maybe in the parking lot at the school run.
Yes.
Those conversations, unfortunately, people are human and they tend to share their success, but they're not so quick to share their less successful journeys. And so many people that are on this journey also look to how can I actually measure if I'm a successful investor? And I specifically warn people against measuring the success of your investment journey through looking at the performance of your portfolio.
Sure. We like the green arrows.
I'm telling you, exactly. And it's certainly look at it, and that might be ultimately our aim. We want to grow our wealth, but that is not the measure of our success as an investor, because there's quite a bit of that we don't have in our control. And so the danger, if we only look at the performance of our portfolio, is that when things go south, when they go those red arrows, like March 2020 with COVID, or mid-2022 when US markets fell between 20 and 30%, we then look at our portfolio and we think, oh, I'm terrible at this. I'm useless. I can't do this because look how bad my performance in my portfolio is. And that's not you, that was the market. Yeah. Similarly, when things go well and there's all the green arrows up, I feel like a rock star. This is me. I'm so clever. I'm so good. And again, let's just give credit where credit is due. It's mostly the market. But what is it? And we come back to those C's, the contributions, the consistency, the costs. Yes. And having a well-defined strategy for your investments. And you measure the success of you as an investor by how well do you adhere to your strategy. Are you able to weather the storms? Are you able to stay the course when things get wobbly? Are you sticking to not just the consistency of your investment process, but also what you invest in? Do you not get swayed by the latest fad or the whatever? So unfortunately, performance is so readily available. I mean, we see it on the news reports every single day. We see it in our statements when it comes our way. When I look at my investment statement, it doesn't tell me anything about how consistent and good I was in terms of sticking to my strategy. Yes. That's something that I have to do myself. My portfolio performance is going to tell me about what the market did. It's not going to tell me about what I did. So to be a successful investor, make sure that you know what your targets are that you set for yourself in terms of your actions, and measure yourself against that. That is how you measure a good investor.
This speaks to a theme that we've probably highlighted in many a conversation before: time in the market versus timing the market. And someone might be sitting at home and thinking, oh, what does that mean and how do I, conceptualize it? Does it mean as a 65-year-old it's too late or too early? As a 5-year-old, it's too late, it's too early, and everyone else in between. But help us contextualize the opportunity to invest in ETFs, regardless of your age, but of course just taking advantage of creating an investment strategy that speaks to you and staying invested for the long term.
Absolutely. So this idea of that my investment strategy or my risk profile or my investment objective should be linked to my age is very flawed. It should be linked to your time horizon. Now, time horizon, I'm going to keep it simple and make it two types of time horizon. I either have a relatively short-term time horizon, and here I'm talking not 3 hours or 3 days, I'm talking 3 years, maybe 5 years. And the reason why the horizon is short, because I actually have a specific purpose for that money. I'm saving up to put down a deposit on a house. I'm saving up because I want to buy a car cash rather than through financing. So I've got a very specific goal in mind with what happens with that money. The long term, anything from 5 years up, I don't care if it's 10 or 20 or 50 years, a longer term one is about that building that time in the market, getting the compounding to work for you, all of those sort of things. And you could have a 30-year-old with a very short time horizon because he's actually building up towards a specific target objective. You could have a 70-year-old with an indefinite time horizon because he's building generational wealth, money that will actually be transferred to his beneficiaries, his children and his grandchildren. So let's break the link between our age and our time horizon.
Yeah.
The second thing is then this effect of compounding, the time in the market, why we so emphasize that point. It is because we know investments in risky assets, which is what shares and property and commodities and so on, they are risky investments in the short term. But if you look at their performance over the long term, in the short term, they can go up and down quite a bit. But when you look at it over the longer term, you actually see that trend with the up and down, but going up mostly.
Definitely.
And that's why we need to focus on the long term to ensure that we actually get that return over the long term that we went into these assets for. Now, one of my favorite analogies around this is because we often say all people have got a long-term investment horizon until they don't. And that could be for many different reasons. It might be because suddenly there's a wobble in the market or whatever the case might be. But I'm going to come back to my cake analogy again. When I want to bake a cake, I've picked my recipe, I've got my ingredients, I follow the instructions, I do everything as I should, and I put that cake in the oven.
Yes.
And my recipe says it's got to bake for an hour. So I know I'm supposed to wait for an hour. If I, after 5 minutes, now go to that oven and say, hello, cake, what's happening? And then the worst thing ever, open the oven door, stick my finger in the batter to check, why do I not have a cake yet? I'm never going to have a cake. And the same applies to investments. If I know that my investment horizon is long-term, 5 years plus, I cannot after 3 months go there and say, but why is nothing happening? Why do I not see this? And worst, then open that investment portfolio and stick your grubby little fingers in your investment portfolio and start fiddling, because that's when we fall into that classic trap of buy high and sell low. So think of the cake analogy. Understand that you are there for an hour. Is a good reason why an oven comes with a glass window. You're allowed to look at your cake baking inside there, but you're not allowed to open the door. Do the same with your investments. By all means, have a look at your portfolio. Look at your statement. Look at it through the glass door.
Yes.
But don't get your grubby fingers inside that batter and spoil the party for yourself.
I think such a practical analogy for all of us, right? We'll be salivating soon. But Nerina, we've walked this beautiful journey of really understanding the role and function of ETFs, how we as investors can participate, knowing the kind of discipline that we need to implement, and of course following through with the 3 C's as you've mentioned. We want to enjoy this cake at some point, right? And take it out of the oven and perhaps add some frosting and some decorations to it and, of course, enjoy it. But it's not a journey that needs to be forced or hurried. And maybe before we do wrap up this conversation, what are, I guess, some of the key takeaway points you want us to bear in mind as investors regarding investing in ETFs, but keeping an open mind that there's still opportunities for so much more growth, to not only have a cake in the oven, you could have a few muffins as well that you could slot in later and continue to see ongoing growth here.
Indeed. I'm going to move on to a different analogy and move to my fruit trees rather than just the cake, because why do we invest? When we say we invest because we want to grow wealth, we want to grow our assets, we want to become financially free, it means that we want to build up an asset base that is sufficiently large that it can sustain us in later years. Sustaining meaning that you can eat off that pot, you can feast off the proceeds of that. So in the apple tree analogy, I can eat the apples that come from the tree, but not chop down the tree. And that's really our intention. When I say to people, the objective of a long-term investment portfolio is for you to never use that money. They look totally horrified, but then why am I doing it? But once you're eating the fruit.
Yes.
And that's really where we want to go to, is because the aim of being financially free means that instead of you earning your money from your blood, sweat and tears, you earn your money from the assets that you've built up. And that's really our intention and what we want to do. So also when we are focusing on a long-term wealth creation process, yes, those contributions, the consistency doing that, but also then focusing on investments that will give you capital growth over the longer term. income is not as important a consideration for such a long-term investment portfolio. But when we look at the makeup of total return coming partly from capital growth and partly from income, the more capital growth you have and the less income in that single ETF or that single investment, the more variable it tends to be, the more volatile. So it appears to be more risky. Whereas when you look at ETFs and investment portfolios that have a much higher income component, whether it's from interest or from dividends, and a relatively smaller part from capital appreciation, they appear to be lower risk because they are less variable, but they also don't give you the capital growth over the long term. So selecting the right types of ETFs for a portfolio is very much dependent on your objective. Is my objective to grow capital over the long term, or am I looking at something shorter term focus where I actually need a lot more income rather than that capital growth? This conversation, I think we can go on for the longest time. I just want to reiterate again how valuable ETFs are from the transparency perspective. The fact that you can actually see exactly what's going on inside it. And so I encourage investors also to go and read those fact sheets of the funds. Don't read them for their past performance. Read them for the investment objective. Look at what they actually hold. Am I getting, eat some more biscuits, or am I getting ginger nuts in my, what am I getting in my hamper? Because that's going to start helping you to relate back to why am I invested in this and what is it that I will be getting from that investment portfolio. This is not a quick learning process, but you can be comfortable in the knowledge that being invested in an ETF already gives you a lot of diversification that mitigates a lot of the risks associated with individual investments. Get involved. Get behind that wheel of the car and then learn on the job. Learn through the process. Learn by engaging with your investments and say, I heard something happened in the world. Let me see what happens in my investment portfolio. When this type of thing happens, what did that mean for my portfolio? Did it have a positive impact on my portfolio or a negative impact on my portfolio? And over time, you start being able to better create that bridge, that link between the world around us, things that happen, whether they are in the economy or whether they are in politics or whether they are just in real life, versus how does that translate through into my investment portfolio. And I think that's how we learn to become more savvy with our investments, but help us to also stay that course and say, I don't need to panic just because the news media gave me big flashing red lights and all in caps. I'm okay. I know that I'm in the right diversified portfolio of investments for my objective and for my time horizon.
Definitely.
Then it's very easy to sit back, be calm and be relaxed and live your life rather than worry about your investments.
And live your life eating the fruits of your investment.
Absolutely.
Fantastic. So we're planting, we're baking, we're harvesting, but fundamentally how we get to this journey is all through transparency. As Nerina mentioned, it's all through the contributions, the consistency and understanding the costs, but also making sure that you actively play a role in embarking on this journey of craving more knowledge, understanding the information that is being shared with you regarding ETFs, remaining committed for the long term, 5 years on, and of course understanding how that does speak to your perhaps time horizon. So it might be 5 years or maybe even longer, but that's for you to decide. Ultimately, regardless what your investment objectives might be, exchange traded funds are certainly an avenue for you to consider in order to make sure that not only do you create wealth sustainably, but also do so in a manner that actually speaks and works for you as an individual. Such a pleasure having you with us for this amazing conversation that we've had today. Nerina, I can speak to you for hours on end. So appreciative of the knowledge that you've shared with us today.
My pleasure. Thank you for the opportunity, Gugu. And I really wish all of the viewers of the Investor Avenue podcast much success in their investment journey, as encapsulated by taking the right action, having a well-defined strategy, and sticking to your plan.
100%. Couldn't have said it better myself. Thanks again, Nerina Visser, who joins us as Executive Director at ETFSA, another platform you can consider to make sure that you start your journey regarding investing in ETFs. Do join us again for the next episode of Investor Avenue. But for myself, Gugulethu Mfuphi and the team, it's been fantastic having you. Have a wonderful day further.